the main upcoming event of the week is tomorrow with the FOMC statement coming up. A lot of people are glued to their screens and they're preparing for the event. So it definitely is a very important day to be aware of what is going on. And I am going to point out important do's and don'ts in the preparation of this very important event for tomorrow. And I'm going to basically analyze the different outcomes and different scenarios of Fed rate decision, if in case there is going to be a rate hike, in case there is not going to be a rate hike, what you should do. And obviously we are also going to point out best currency pairs to trade this week, before the Fed rate decision, after the Fed rate decision, in the long run and in the short run. So a lot to cover today. Today's agenda, as you can see over here, let me open up. So basically this is what we're going to do today. We're going to do a global market overview, and we're going to do a live market walkthrough. So if you haven't already, definitely bring up your Orbex trading platforms, whether it's a demo account or a real account, so that you can also go ahead and do the analysis and basically mark the levels that I will be covering during the webinar on your charts to make it easier for you to trade later. Definitely have your charts, definitely have your trading platform all open. And if you want, you can also have a notepad and a pen ready so that you can take notes on the important statements that I will say. We don't have much of a presentation, like in terms of a PowerPoint written presentation. I will be just saying all the comments, and I will be doing all the analysis verbally. So it is a good idea to have a notepad right near you. Before we get started, we do have enough people already. Could you please do a mic check? Can everybody hear me? Please type in the Y for yes if you can hear me, so that we can go ahead and start the webinar. Thank you. Hello, Demir. Hello, Tony, Maria, Mohammed. Thank you so much for your feedback. Okay. So before again we go in, let's take a look at Orbex library. Definitely take a look at basically sign up for Orbex Trading Library and their news feed, because they do send out important market updates throughout the day. So you do want to take a look at it. We do have a web TV that is hosted by me. I cover the most upcoming economic data before it happens, so that you can mark up your calendars. So a lot of stuff you can find in the Orbex Traders Library. As for myself and the reason why you're here, my name is Kiana. Nice to meet you. I'm the founder and CEO of InvestDiva.com. I'm the author of a best-selling book, Invest Diva's Guide to Making Money in Forex, published by McGraw-Hill. I've been featured in NASDAQ. We're a NASDAQ, New York Stock Exchange, Forbes, Times, and so many other mediums. So I guess I do know what I'm talking about when it comes to Forex trading. And if you want to get more information or sign up for my newsletter, definitely go to InvestDiva.com and take a look at that. You can also enroll in our education course for a private lesson. You can also look at your options to have a one-on-one trading analysis with myself. So without further ado, I am going to go ahead and bring up my Orbex trading platform. I want you to at the same time do the same. Bring up your Forex trading, your Orbex trading platform. And as you can see, I have already changed my screen from black to white. This is just a matter of choice. I like it better. It's easier on my eyes. You can do so if you like as well by going into properties over here. So you go to properties and you can change the colors of the candlesticks and the background and the foreground to whatever you like. For me, I have changed the background to white, foreground to black, which shows the prices on the calendar. I have my bullish candles shown in green color and my bearish candles shown in purple color. So let's keep that in mind. You can do the same. If you don't, that is fine. It is just, as I said, a matter of choice. One other thing that I don't like on my chart is the grid. It makes me confused, so I go ahead and click the grid off my chart. Sorry about that. So that's basically it. This is an hourly chart of the Aussie Yen pair. So as you can see over here, we have so many different currency pairs that we can go through today. What I am going to suggest first is to prepare basically. What is more important today is to be prepared for the Fed rate hike, as I said before. And that means you want to avoid potentially the currency pairs that could be impacted by any outcome tomorrow. Trading the volatility is both good and bad. As I posted an article today on Investiva over here that you can take a look at later. It is important to, as a responsible trader, it is important to educate yourself, first of all, that what is the outcome going to be. And number two is I recommend actually avoiding and staying away from the currency that is most likely going to be affected by any outcome from the Federal Reserve. Can any of you tell me which currency is that? What currency should we avoid trading today and tomorrow? I'm going to give you five seconds. 1, 2, 3, 4. Yes, that's correct, Mohammed. It is the US dollar that you have to avoid, and I recommend that you avoid during the volatility. The reason why is that regardless of the outcome, the US dollar is bound to be going up and down. It's bound to shake up tomorrow, right? So as a day trader, many people are taking this as an opportunity to get into the market and basically move on with the ride and potentially make some pips. But as I have said in my book, and I say to my students, that is very much like a gambling style. I am very much against gambling when it comes to forex trading, because even though with any outcome tomorrow, you may have potential of making money, you equally have a potential of losing money, and therefore I avoid being in those positions. That being said, as I know a lot of you guys may want to know what are the scenarios that could happen tomorrow. So before we get into the things that we can trade today, I do want to go ahead and give you the scenarios, the potential scenarios of any outcome for tomorrow's Fed rate decision. And what you should expect and how you can trade after that. After that, we can go ahead and have a couple of scenarios or strategies for the pairs that we can trade today. So any dollar cross, including the euro, dollar yen, dollar cat, Aussie dollar, dollar Swissy, and pound dollar are subject to volatility tomorrow, Thursday at 7:30 p.m. GMT, before and after, all right? And the two scenarios are simple. The Fed is either going to rate the hikes or not. A little bit more adding more complexity to the situation is that the Fed wouldn't rate hikes, but it hints that it will hike the rates in December. That would also create a little bit of a more different strategy for forex traders. Another less likely scenario is that the Fed doesn't hike the rates and says that they are not going to hike the rates at all in the coming year or next year. That is very unlikely to happen because we have been getting the hints from the Fed, the more or less it is likely to hike rates at some point in 2015 or 2016. So the last thing that I said is very unlikely. 30% of market participants are expecting a rate hike tomorrow, and the rest of the 70% are expecting a no change in rate hike tomorrow. So what is going to happen if the Fed does hike the rates on Thursday? So the initial reaction of the US dollar, why is the rate hike, first of all, let me explain this to you. Why is the interest rate so important for currencies and the stock markets alike? The reason why is that it is basically it shows the economic strength of a country, and depending on the culture of the country, it can greatly impact the investing, the buying and selling, and the investors' behavior in the markets. So for example, in the US case, if the interest rates go up, that means that a lot of investors would want to invest their money in, say, real estate, or invest in stocks, or invest in even the US dollar, because a hike in interest rates shows that the economy is doing well, that there is potential for additional growth in the country. Therefore, we could expect strength in the US dollar, and we could expect that the US dollar would go up basically against its forex counterparts. Conversely, if the Fed doesn't hike interest rates, that means that it is not yet confident in the economy, and there is more room. It needs to have more clues for more cues for an economic growth. So that could the immediate reaction of the market could be a sell-off of the US dollar, because the investors who were expecting a rate hike, first of all, are going to be disappointed, so they may just get rid of their dollar investments, as well as other instruments such as stocks. Real estate is a little bit harder to get rid of, right? So the US dollar would actually be probably the first to get an impact from a rate decision tomorrow. All right. So what is going to happen, for example, let's say the euro versus the dollar. All right. So this is the euro dollar chart, daily chart, as I have over here. You can go ahead and have your daily chart up as well. I'm going to add a bunch of indications of how the market is doing later on. But just looking at the chart and the moving average, you notice that the market has been ranging basically between two levels around, let me actually add a horizontal line. So the market has been ranging between approximately 114 and approximately 104, 105 since March. So this has been the range. We do not see a real trend. The latest trend that we saw was the downtrend that started back in, okay, actually I may need the grid over here for this, that started back in April 2014 and ended in March. Okay, so a lot of people, because we hit a very important support level of 104 at the time, a lot of people were expecting further down moves of the pair, but what happened is that because of all the situations going on in Greece and the confusion in the indecisiveness of the US dollar, we have been seeing more or less a range in the market in the past few months, in the past 6 months, right? So the initial reaction, let's go to the two scenarios. If there is no rate hike tomorrow, all right, as I said, the initial reaction to the US dollar would be a sell-off. That means because the euro dollar, the dollar is a quote currency, the euro dollar will get stronger, will go up on the chart. So an immediate reaction to a no rate hike scenario tomorrow could be euro dollar strength in up moves up to even levels of 114. The second scenario is a rate hike of euro dollar, which will bring you an initial reaction of very strong dollar that will push the euro dollar pair down, probably even towards, you can see a spike. A rate hike could really create an enormous amount of volatility. You could see a spike within the first few minutes of the statement release to even 109, I would say. But after that, the market should come down within the first hour. So the initial reaction in case of a no rate hike would be an up move. Our resistance level would be at 116. And an immediate reaction to a rate hike would be a down move with support level set at 109, 106, 108. All right. So after that, in case of a no rate hike, what's going to happen is that the market is going to probably go back to what it was doing before, which is continuing in the range until whenever the Fed decides to hike the interest rates, or if we have another surprise from China like we had last August that made the markets really move a lot, or any other surprises, right? So in case of a no rate hike tomorrow, we could expect the pair to range for a while, another 2 to 3 months on the euro dollar chart. However, in case of a rate hike, as I said, the immediate reaction would be a euro dollar down move, but that will most likely turn into an actual new downtrend in the pair. So a rate hike scenario for the euro dollar would mean a change in direction, a break of a consolidation, and a formation of a new downtrend. So what you could do after the rate decision tomorrow, in case the Fed decides to raise the interest rates, is to actually get into a bearish position on the euro dollar. That could bring the euro dollar actually back to parity. The parity means having the euro dollar pair all the way back to 1 or even lower. So a rate hike tomorrow would give you an indication of getting into a long-term bearish position in the euro dollar pair. All right, so we covered that. Do we have any questions up until here? All right, so I'm going to cover another dollar pair before we move on to today's trading. Another pair that I do want to choose is a dollar-yen pair. The reason why is that the yen has been very slow in its movement, and it has been basically dragged by the US dollar after the China's shock happened back in August. So I'm going to go ahead and open up my dollar-yen chart. This one unfortunately is in the black, but if you're used to this, that is fine. We're just gonna have a very small amount of time on here. So this is the dollar-yen chart. The daily chart. Okay, so as you can see, the dollar-yen has been ranging even for a longer period. It started its range in November, back in November 2010, after the uptrend that we had in the US dollar. The speculation was that the dollar-yen is going to continue going up back to the highs of 2004, 2005. However, so these are the highs. If you go to the monthly chart, you will see that the market has actually completed a saucer chart pattern that we have discussed in previous webinars. and currently it is basically testing the neckline. It briefly broke, tested above the neckline. It hasn't been able to break above the neckline of the saucer. As you can see, this is the neckline of the saucer. All right, so what we were waiting is basically upon a rate hike of the U.S. Federal Reserve, we could expect the dollar-yen pair to go up back to the levels of 2001, which is crazy. It's back in the 134 levels, or even higher. Back to, this is crazy, and pretty much I would say unlikely, because Japan is not in the situation, in the position that it was back in the 1998. But anything is possible in the forex world. So our extended, very long-term targets for the dollar-yen pair in case of a rate hike would be the 140 levels. So pretty much of really crazy amounts, right? So this is the monthly chart of dollar-yen pair again, I have to mention. And this was a long-term perspective of whenever the rate hike happens, we could expect the dollar-yen pair to reach these levels, all right, one of these levels, to say the least, all right? But the immediate reaction for tomorrow, let's see what that could be. So going back to the daily chart, which is the best chart to look at right now because we want to trade a little bit on a shorter term basis. After the China's panic attack on Black Monday back in August 24th, the dollar-yen pair dropped from its comfort zone. It created a double top chart pattern over here. And let me actually mark it down for you. Okay, and so you can see this is the first top and the second top, and this is the valley. It broke below the neckline. This is the neckline of the double top, right? So it broke below the neckline, and then it reached, within the matters of 4 minutes, it reached the lows of 116, and then it is now back to where it was before, and it is ranging. The range now is trapped basically inside a triangle chart pattern. Let's see how I can draw the lines over here. So if you connect the highs with the lows, you can see that the pair is actually trapped in a triangle chart pattern, and it has been zigzagging with a lower volume, which means a triangle chart pattern is normally an indication of a calm before the storm, and you could expect a breakout in either direction. So in case of a rate hike tomorrow, again, the initial reaction and the long-term reaction would be dollar strength. So that could be our cue of a breakout above the triangle, and we could see gains towards the 121, 124, and above levels. Now, a no rate hike scenario for the dollar-yen pair would have an initial reaction of probably even a testing below the triangle, and then the market would probably go back down with a hint of a bullish sentiment later on, especially if the Fed does hint that it is going to rate hike sometime within 2015. So if the Fed doesn't raise the rates tomorrow, but does hint that it is going to do so in December, that is also a bullish signal, and we could expect more hikes in the dollar-yen pair along with all the other dollar crosses. All right. So these are the scenarios that we basically had for the dollar crosses. Now, as I said, it is best to avoid trading the dollar crosses today and tomorrow because of the high potential of volatility before the Fed rate statement. So what should we trade right now? There are a bunch of things going on. Do you have any personal recommendations, any of you? What is it that you are eyeing right now that you want me to cover based on the votes? I could go ahead and cover any other questions that you may have, and in the meantime I can go ahead and pick another pair that you could basically trade today. All right, so before we get into your questions, I do want to mention that some of the best performing currencies right now are the commodity currencies. The reason why, especially the Aussie and the Kiwi, the reason why, especially for Australian dollar, is that the month of September is the beginning of spring in Australia, and spring is normally one of the best months. It's basically a beginning of the weather getting warmer. People may want to go shopping more. Also, Christmas shopping could begin even in this month. So if you look at the Aussie charts, any Aussie chart, let's take a look at this is the Aussie Yen chart. I'm going to go back to the monthly and seeing what has been happening during the month of September in the past 10 years. So as you can see, for example, let's start from 2000. Okay, this is a little bit. So starting from, hold on one second. So going back, for example, let's say to 2008 and looking at July, August, September, November, July, August, September, right? So you can see that normally we see a hike in the prices. Well, not much probably in 2009. Let's take a look at 2010. We normally see a hike in the rates in the Aussie prices during the 3 months of spring in the land down under, you see. So we had September over here, the prices rose. In 2012 the prices rose September to December. In 2013 again we had 4 consecutive months of hikes, and in 2014 as well, this is September, we had more or less of a hike in the Aussie prices. All right, so that is why. So now, right now, if you see, this is the September candlestick for the Aussie Yen pair, and the market more or less has been sort of bullish, more on the incisive side, but it has been showing strength. So that is one of the reasons why I always like to trade the Aussie dollar on the bullish side beginning of September. The reason why right now I'm choosing the Australian dollar versus the Japanese yen is because the Japanese yen basically claimed its position as a safe haven in Asia with Chinese problems at the moment, and it is we could say it's one of the least risky assets in Asia. You don't expect much of a surprise coming out from Japan, so it could be a good idea to pair up anything that you want to trade at the moment against the Japanese yen, so that you only have to basically follow one currency's economy to make a trading decision. So while we're at it on the monthly chart of Aussie Yen pair, and I already know what the reason why I chose the Aussie Yen. What we can see is that going back to 2008, the Aussie Yen has generally been in an upward movement. Not a very strong one, but generally has been in an upward movement, right? So the prices have generally been going up. Another one over here could almost actually even make a channel. It doesn't fit properly, but more or less it does resemble a channel for us. So the Aussie Yen pair has been going zigzagging within this upward channel. The resistance level being this upper line and the support level being this resistance line, the lower band of the channel over here. All right. So as I said, since we expect the Aussie to move up in the months of September until December, we could basically go ahead and make the analysis on the shorter term basis, say in the daily, and see how we can do it. So on the daily, you can see that the upward movement has already begun. And if you already are in a bullish position on the Australian dollar, that's great. If you're not, let's see what are the prices, what can we expect for the pair. So I'm going to take advantage of using a bunch of indicators. Let's add one of my favorites. Ichimoku Kinko Hyo. It is not very visible, but as you can see, the Tenkan line has already started to go up. It has yet to cross above the Kijun line. But one thing that I have to tell you right now is that because of the spike in the Aussie dollar, in the Aussie back in Australia and back in August, you see this drop over here. That was an unexpected, not reliable signal for us. So if the China's stock market hadn't plummeted back in August and the market hasn't panicked back in August, this sudden drop would not have happened. All right, and in that case, the recovery of Aussie dollar for the months of September could have actually started around here. So what I mean by this is that right now the pair is below the Ichimoku cloud. Normally this would be an indication that the market is on a downtrend. But right now I actually cannot use Ichimoku cloud as a reliable daily chart indicator. Why? Because of this market panic. This was a 4-minute market panic that impacted the gradual movement of moving averages. So on a daily basis, the recovery still hasn't been reflected on the moving averages. So do not use moving averages on daily chart for another, I would say, month until the reflection of that market panic is gone. Another chart that is actually good to be used right now with moving averages is the 4-hour chart. And as you can see, the market, because the reflection of the panic attack has already been done and gone, and as you can see, the pair has already broken above the Ichimoku cloud, which is definitely a signal of more up moves to come up. So that was the Ichimoku indication trading. Do we get rid of it? Oh, all right. I guess I just closed down my chart. Hold on 1 second until I bring it back up. So as we were saying, on the daily chart of the Aussie dollar, we are not going to rely on Ichimoku, but on the 4-hour chart, we are. So let's say that we are going to get into a bullish position in Aussie dollar. What should be our stop and limit orders? Obviously, one of the first things that you want to do, we already have a support level for us drawn over here. So this is one of the support levels, the lower band of the channel, going well to 85. Another way to choose our support and resistance levels are using a Fibonacci in the latest downtrend, because what Fibonacci basically suggests is that, well, I guess the reason why we cannot really see what is going on in this chart is because I have changed the formats of my chart from black to white. So we're going to reverse it back to this because it's going to be faster. So if we do this, you're going to be able to see the Fibonacci retracement levels more clearly. Right now the pair has already broken above the 23% Fibonacci level, yet another indication of an uptrend coming up. Our next levels, our targets on a short-term basis could be the 50%. No, I'm sorry, the 38%. This is the 38%. The next one could be the 50%. Anywhere above that I won't recommend because before I would right now if I was get to into position, I would target either 87.70 and in extension I would target 89, but not above that. And as you can see, the Fibonacci retracement falls perfectly at a previous support right over here. As you can see, the market tested this level at 89.50 twice back in July, and making it a very important level, and the 50% falls perfectly on it, which means that this could be one of the main key levels, psychological levels, and the market could have difficulties breaking above it. So as a bullish scenario, I would recommend targets for Aussie Yen at 87.70 and 89.50 in extension. If you want to take notes, this is a good time to do it. But every time that you have a scenario, you always have to come up with a counter scenario. So what if, even though our strategies and our analysis show that the Aussie Yen pair could go up in the near future, what if it doesn't happen? What if China comes up with a really bad news and Australian dollar moves down? In that case, you always have to prepare. You have to be prepared. You have to have your stop loss in order. How do we choose our stop loss? Best case, and step number one is to calculate your assets, calculate your account. How much money are you able to lose without wiping out your account? So that is number one. How much is your risk appetite? Are you able to lose more money or less money? So you calculate that on your basis. I cannot do that for you right now because I don't know about your account. For that, we can have a private lesson with me. But that is something you have to do on your own. The next general step and some ideas on how to set your stop losses basically is also using these support levels or Fibonacci levels for this case. So as a general rule of thumb, if I get into the market at, let's say, 23% Fibonacci level at 85, or even if I get on it now, it has already reached 86.70. So I would recommend a stop loss set at a previous support level over here, which is 83.70, and the extended stop loss would be, again, the previous bottomed out number of 82.15. Now, again, I have to stress on this. If you do have the ability to trade on a higher margin and your account is big enough and you're already proven to have more other winning positions, you could go ahead and have your stop loss a little bit lower than what it is right now based on a weekly or a monthly chart. Oh, I guess I probably logged out of my thing. So based on the monthly and the weekly chart, I move it a little bit lower. I'm not going to get into that because that is a little bit risky. That is on you, and you have to do your own analysis to coming up with that. So to sum it up for Aussie Yen, right now the outlook is bullish. The targets are 87.70 and 89.50. Stop loss, support levels at 82.15 and 83.70. All right. Any questions up until here? Okay. Since we're good on this, so next, since I have unfortunately logged out of my Orbix platform, I have to apologize for a second so I can log in it. So I was able to bring up my monthly chart for Aussie Yen. It is a little bit hard to see, but on the monthly chart, if you were to move your stop loss a little bit lower, a good next strategy would be around here at 76. Keep in mind, I do not recommend that at the moment. That is a little bit way too risky. All right, so I'm going to cover one last currency before we go. If you have any suggestions, definitely do tell me what you want me to cover up today. Otherwise, I am going to go. And what did we talk about? We said that commodity currencies could be a good option for now. And we do not want, and we would rather avoid US dollars. So let's go through the pairs over here. These are all dollar based. Dollar yen, euro pound. Our options are euro Aussie, euro Swiss, euro yen, potentially CAD yen, and so forth. So I'm going to give you a reason why I'm not going to go with euro at the moment, because euro has been putting out a lot of mixed signals. In the past couple of days, the German data came out lower than expected, while the GDP had actually grown. So a little bit of a mixed signal. We don't know. We don't have much clarity on the economic side on the European currency. So therefore, I would like to avoid that. Another currency that I mentioned before that could be a good potential for now could be actually Kiwi. Let's see what is going on in the Kiwi versus Japanese yen. So I'm going to go ahead again on my Forex chart, Orbix chart, and open up a new chart. New chart on your files. We are going to choose Kiwi yen and see if there is anything coming up for the pair. For some reason, I'm again not able to view it. Unfortunately, I think I have to go ahead and bring up another chart. Hold on one second. So this is the Kiwi Yen chart. Let's see if we have any potentials right now. Looking at this chart right now at the first glance, what do you see? What is the movement of the chart? In general, again, as I said, you can see a downtrend, right? Including the drop back in August. What else do we see? If we zoom back a little bit, we see the downtrend that actually has been going on for a while. So we had a double top pattern over here, then we had a spike, then the downtrend continued again. What is the lowest the Kiwi dollar can go? For that, I have to go ahead and change into the monthly chart. So reverting back to monthly, you can see that back in 2009, actually, the pair was way below what it is right now. So kind of the indication right now is that maybe the market, the Kiwi yen pair, still has some way to go. What do you think? Is this a beginning of a double top pattern? Is this the beginning of a saucer pattern? What is going on in the Kiwi yen pair? We have to do a very thorough analysis on this, starting from the monthly chart. Okay, so here are the steps that I'm going to do. So first, I'm going to identify our support and resistance levels on a long-term basis. And then I'm going to see if I see any chart patterns coming up. All right. So the most vivid resistance level in the long term is obviously this level, because we have had the prices test 93 level twice, once in 2014 and once back in the day in 2007. This is the highest the Kiwi yen has ever got in the history of online forex trading. All right, so this is a point that we definitely want to mark up. Where else can we mark up as a resistance level? Another high that the market has tested below that stands out is around here. Again, we've had this level tested twice in the history of forex trading. Once back in the day in 2005 and one more time in 2013. All right, right now the market is below this level. So our pivot level should be somewhere below this, obviously, right? Look at this. Where the market right now is and where it had tested back in 2013 kind of aligns. And not only that, it aligns with the price testing back in 2004 in March and in November. So this is definitely one of the pivot levels that we can point out at the moment. We're going to clear it up later on using other indicators, but for now, you just want to have an approximate idea of the levels that you could trade on. After the pivot level, you want to choose your support level. The support level are the bottoms or the resistance levels that have turned into support level in the past. So obviously right now we cannot use any of that for current price action, but what we could use is a previous low or a previous high that the market has tested a bunch in the past. So I'm going to show you why I chose this level is because back in 2003, 2004, and 2006, and 2010, 2011, and 2012, Kiwi Yen tested 69.50 or around this level, this range over here. So this range between, let's say, 70 and 68 is a support zone for the Kiwi. We're going to point a middle point for this just so that we can have a clearer idea. Now, where is the market going? Is it going to go further up or further down? As I said, spring is starting in New Zealand as well. September, October, November, and December could be a potential up move season for Kiwi. Let's say how the market had reacted, how the pair has reacted in the past. Let's see. So in 2014, in September, the market actually hasn't been going up from September. So this is a little bit different from Australian dollar, isn't it? Back in 2013, from October, November until December, well, the pair actually did go up in that season. In 2012, the market did go up until December. In 2011, the market was more or less indecisive, mostly to the downside. In 2010, what happened is the market actually went up in this 3 months. 2009, the market went up during this 3 months, but in December it actually spiked down. So as you can see, we cannot really rely on the seasonal change for the Kiwi. So that is out of the question. We have to rely on other stuff that is going on in the Kiwi. One thing that is coming up on Kiwi dollar is today's GDP prices, and depending on that, we could see if the Kiwi is behaving better or worse. So I'm going to check up my economic calendar to see how the Kiwi has behaved in the past couple of months, how the New Zealand economy has been doing in the past couple of months. So bear with me until I pull up my calendar. So the monetary policy statement is going to come out. It has already come out. In October, we have a Labor Day in New Zealand. And previously, the market actually hasn't been doing very well in Kiwi. So chances are that Kiwi may go back. Right now, the candlestick that we're seeing this month is a bit of an indecisive candlestick. Okay, so how do we use this? Are we going to ride on a downtrend, on the most recent downtrend, or are we going to look at a potential holdback correction and then going back to downtrend? There are so many scenarios right now that comes to mind. So because it is not very clear at the moment, I'm going to go ahead and use my Fibonacci retracement on the uptrend first to see, first of all, how our support and resistances fell in. So as you can see, the 38% was very close to our pivot level, so this definitely is a pivot level and is a very important level. That is the reason why we don't really know what is going on, because the pair has been testing the pivot level at 75, 30 around area, but it hasn't been able to break below it. A break below a 38% Fibonacci level and this pivot level, now we know, could indicate further drops towards the 50% Fibonacci level at 69.50. All right, these are the important things that you should be writing down right now. However, how about the bullish scenario? We have to come up with a bullish scenario as well. We cannot see a bullish scenario right now based on the monthly chart alone, so I am going to revert back to the daily chart, or actually potentially, yeah, a daily chart would be good for a bullish scenario so that we can basically come up with what we do want to do with the pair. So the sudden drop in August 2015 was also true for the Kiwi Yen pair, right? Other indications right now that we can use is definitely Ichimoku. So the pair has been below the Ichimoku cloud and it hasn't even been testing above it. Even if we go back to the 4-hour chart, the pair has been ranging within about a flattening Ichimoku cloud. So Ichimoku indicator right now, we understand that cannot be as much of a help for us in the Kiwi Yen pair. All right, but still, since the cloud is kind of in a downtrend, I would want to take a look at the downtrend and see what are the levels that we could potentially take a look. So what is going on right now? Right now, the pair, after being on a downtrend since April, it kind of seems like it reached the bottom, and it is in a bit of an uptrend right now. Before the Chinese panic attack happened, the pair was actually consolidating over here. So again, likewise, again, just like the euro dollar or any other pairs that we analyzed today, if the China stock drop had not happened back in August, the pair probably would have been ranging right now with a bit of a bullish sentiment. So it would have been around here if this hadn't happened, right? You want to basically take this off and bring up this to here. So with the current past week of bullish movements in the pair, we could have expected the pair to have been moving up a little bit up to here, right? So that means maybe the market was testing to see if it can get into a bullish sentiment. Right now, the bullish sentiment is not really strong. We have indecisiveness going on, but it is higher than the bearish sentiment. What I'm trying to say right now is that actually we cannot come up with a conclusion with the Kiwi Yen at the moment. Why is this important? I just wanted to, so what you have to keep in mind is that more trades don't bring you more wins. Even if you think that something is going to be a winning trade, you always have to do the analysis from all points, from fundamental, technical, sentiment, market sentiment points of view to see if that is a smart move or not. My initial reaction today, my initial gut feeling was that, oh, if Aussie dollar is being bullish, probably the Kiwi is going in the same direction, and we could trade the Kiwi Yen pair as well. But guess what? After doing the analysis thoroughly, I found out that the market actually right now is pretty much indecisive, and what we could do is keeping an eye on the Kiwi Yen pair for a break either above or below the 75.50 level. So the scenarios for this pair right now is this: a break below 75.50 would open doors for more drops to our next support level, very important support level as 50% at 50% Fibonacci, which is 69.50. So keep an eye on this in the next week or months. If the pair does break below it, if it confirms the break below it, then you can enter a bearish position targeting 69.50. On the other hand, is if the pair changes directions and breaks above the Ichimoku cloud or at least the 23% Fibonacci level, you want to mark this down, the 23% Fibonacci on the downtrend. This retracement is going to be your second pivot point, right? So after, when and if the market, the Kiwi Yen pair breaks above 78.70, that is your cue for entering a bullish position, targeting your next support level, resistance level, or which could be either this zone, the place where the pair was ranging before, which is the 81 area. The extended bullish target would be 84. If you're asking me what might happen with the Kiwi in the coming months, I would say that I'm a little bit more looking forward to a bullish situation for the Kiwi, just because I believe that it kind of wants to go back to its comfort zone. It was consolidating before around this area, so the chances are that it's going to find its way back up to this range, and then it could basically decide on its long-term direction. That is my it's my gut reaction to it. But obviously, if the pair does break below 75.50, that is void, and you would want to be in a bearish position. All right, so time is up. Thank you so much for joining us. I can see that there are a lot of people, a lot more people who joined us in the past 5 minutes. I don't understand, it's a little bit late. We did cover different currencies today. We covered, we gave you an strategy for trading the Aussie Yen pair. We gave you strategies for trading the Euro dollar pair and the dollar yen pair. So we covered at least 4 currencies, and I gave you tips on how to prep for the FOMC meeting tomorrow. If you did miss out on the beginning of today's webinar, the webinar has been recorded, and you can check it out later on Orbex.com. Another thing you can do if you definitely want to prep up for tomorrow's FOMC and the webinar may not be up by then, I recommend that you go to investiva.com. And thank you so much for joining us today. Trade responsibly, and hopefully I will see you in the next webinar next week. Have a great day.